If I was investing my first £1,000, I would know exactly where to put it because I've done a ton of research. I've looked at various different portfolios, and based on the risk that I'm willing to take, I know what I'm investing in. So in this video, I'm going to break down various portfolios that you could invest into and give you an overall rating on which ones I think are the best. In this video, I'm going to be analyzing 7 different portfolios. The first one is the Global 80/20 portfolio, the second one is Tech Titans, the third one is the Mag 7, the fourth one is Long-Term Compounders, number 5 is Commodities, number 6 is Boring But Steady, and number 7 we have Emerging Markets. So we are going to start off with the very basic one, and I guess you could say it is my favorite one. It is the Global 80/20 portfolio. In the Global 80/20 portfolio, I like to see this as 80% of my £1,000 will go into the Vanguard FTSE All World and 20% into iShares Physical Gold. Now, the Vanguard FTSE All World tracks 3,700 global companies. Yes, 60% of these companies are US based, but the others are ex-global. The remaining 20% of the £1,000 would go into iShares Physical Gold, and this is basically physical gold bars in a vault. You are essentially just buying the ETF though, which tracks the price. And historically, the stock market and gold work inversely. Unfortunately, gold doesn't generate any income. It is purely used as a store of value. Now, the great strengths about this are that it is low cost and it doesn't require any maintenance. You do have pretty much exposure to every major listed company globally. Gold has historically reduced drawdown severity, and it is pretty simple for beginner investors. But in terms of the negatives, again, gold produces zero yield. You don't get dividend from this. You are still subject to significant drawdowns in severe crisis, and sometimes there is a currency risk, but for me there isn't. I would probably rate this at 8.5 out of 10 portfolio. The next one we move on to is Tech Titans. So this is investing into the big tech stocks, for example, Nvidia, Microsoft, Alphabet, Amazon, Meta, TSMC, which is Taiwan Semiconductor, Palantir, AMD, CrowdStrike, Tesla, Duolingo, and Tempest AI. Now, this is very concentrated, and you are essentially betting on AI doing very well. And again, people are talking about the AI bubble might pop, etc. So you should expect high volatility in this one. Now, obviously you have your strengths and your key risks. The strengths include you have direct AI exposure. It contains some of the most profitable businesses ever built. It is a mixture of blue chip and high risk companies, but the key risks are very important. Number 1, it's very, very concentrated. If the bubble does pop, then boom, your portfolio has a big hit. Secondly, the valuations of these companies are so high. Like, personally, I'm staying away from this portfolio because of that. Again, your portfolio value could drop 40 to 60%, which is what could happen in a tech correction. And finally, the biggest risk is you are investing into individual stocks that are very speculative. So things like Tesla, etc., they're not there for low risk investors. So as a beginner, I'd probably rate this a 2 out of 10. Obviously, you could see great upside, but you could also see great downside. We then move on to the next portfolio, which is Mag 7, which is similar to the Tech Titans portfolio, but it's more leaning to the top 7 companies. So the Mag 7 include Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla. So with this, obviously you have your strengths. So you have great cash flow generation. All 7 of these companies are dominant market positions and network effects. It is a lot simpler and easier to monitor than your Tech Titans portfolio because you're again focusing on 7 stocks, and you are essentially capturing the core of what drove the market returns from 2020 to 2024. But obviously the risks are that you are solely focusing on the US sector fund. There's no real diversification. You are very heavily betting on AI. Tesla itself adds significant volatility and valuation controversy. Like, I'm pretty sure Tesla right now is like $300 and something when the actual valuation people are saying it's $100 and something. So again, you are playing with very high valuations. You also do have a big overlap if you have invested into the S&P 500. So if you are an investor that wants to focus on mag cap tech exposure without venturing into smaller speculative names, then I guess this is better than the Tech Titans portfolio. But I'd probably rate this a 6 or 7 out of 10. I personally do invest in these because I believe in some of these companies like Meta and Microsoft and Apple. The other ones, not so much. The next portfolio I'm going to talk about is the long-term compounders portfolio. Now, this portfolio is actually inspired by Warren Buffett, and yes, they are pretty boring stocks, and these include Berkshire Hathaway, Visa, MasterCard, Hermes, S&P Global, Moody's, Constellation Software, P&G, Brookfield Asset Management, Automatic Data Processing, and Alphabet and Microsoft. Now, these are not exciting trades. They're actually boring businesses that compound quietly. Now, I'd probably rate this a 7 or 8 out of 10 because it is, you are dealing with very good quality businesses with proven multi-decade track records. It is also pretty diversified across various sectors, and you have strong dividend growth. But the risks of this portfolio are that the holdings trade at premium valuation, so these companies don't come at a cheap price. So I'd probably say this portfolio is best for patient long-term investors, for example 10+ year horizons, who prioritize quality over speculation. But again, this is a long-term hold portfolio. We then go on to the next portfolio, which is the commodities portfolio. And this is basically when you are investing in raw materials, for example, physical gold, silver, copper, energy, uranium, agriculture, diversified mining, etc. Now, the thing is, I like commodities, don't get me wrong. I love gold, I love silver, but I probably wouldn't be investing in a commodities portfolio. Obviously, you have a low correlation to equities and you actually have good diversification potential, but you don't get intrinsic compounding. Obviously, you don't get paid dividends. Probably I'd rate this as 6.5 out of 10. We then have the next one, which is boring but steady portfolio. And I'd probably rate this one an 8.5 out of 10. And this includes stocks like Johnson & Johnson, Procter & Gamble, Coca-Cola, National Grid, Realty Income, Vicky Properties, Waste Management, British American Tobacco, T-bills, etc. I don't even know half of these, but this portfolio preserves capital preservation, consistent income, and slow compounding through dividend reinvestment. This portfolio does have lower volatility, it has good dividend payouts. Many holdings are actually true economic necessities, for example, the utilities and healthcare aspect of it, and it is psychologically easier to hold during market turbulence. But obviously this portfolio might underperform, especially during tech bull markets. I think with this portfolio, you're going to see lower long-term total return, but again, I think this is a low-risk portfolio. And if you're investing over long periods of times, for example, 10, 20, 30 years, it's it is pretty good. And my final portfolio that I'm going to be evaluating is an emerging markets portfolio. So for example, the Vanguard FTSE EM ETF, India ETF, TSMC, China Internet, Brazil, Vietnam, Saudi Arabia, Africa, cash, etc. This gives you exposure to faster growing economies, for example, Asia, Latin America, Eastern Europe, and Africa. I think it's great. But obviously you are dealing with currency risk, political instability, weaker corporate governance, and a bit of uncertainty. So I'd probably rate this a 6 out of 10. Again, I think this is best for investors with a 10 to 15 year horizon, and you want to seek diversification beyond developed markets. So that is basically a summary of 7 portfolios that I have analyzed. My personal favorite has to go to the very first one, which was Global 80/20, just because I think the risk is the lowest. And I also do like the long-term compounders because boring equals best sometimes. Anyway, if you have liked this video, it would mean a lot if you guys could like, comment, and subscribe. I do have an investing portfolio guide, which you can download from my bio, which covers all of these portfolios. But remember, this video is not financial advice in any way. You have to do your own research when investing. So have a great day, guys. I cannot wait to see your investing journey, and let me know in the comments below which one of these is your favorite portfolio. Have a great day. See you in my next video. Bye-bye.